Welcome everyone to the Kindle Report. It is Wednesday, and what a day it was, huh? The selling just wouldn't stop. It looked like there was a couple points when we got down around S2 that it might hold, and it just kept stair-stepping down. I named this video tonight basically the war effect, and I think a lot of what we're seeing going on is starting to filter into the markets. Not so much the conflict itself, but the influences that it's likely to have, especially anytime you have Joe Biden on a podium talking, it can't be good. And he talked on and on today, and it was some appropriate, but long. And I almost wanted to put a chart together to show you as he started talking how the markets declined. But I think it was not necessarily that he was talking, it's the realization that we're going to be spending a lot of money on wars, and that doesn't seem like it's going to go away. So let's go to a couple things here, and I'll come back to that because there's definitely some things I want to mention from that standpoint, and I think you'll understand. And by the way, just before I get too deep into tonight's video, I appreciate everybody actually filling out the surveys that we put out. There's more coming out. We had a lot back. We're going to do another day. Tomorrow night, I will announce the actual time, and we'll start to be putting out the information early next week on everything that is going to be happening as far as the agenda and everything for the webinar that's upcoming. And we'll have those dates out to you tomorrow night. So that'll be the announcement. So also remember to subscribe, like, share, do all that stuff here on the channel. Yeah, so a couple of things here we'll cover. I had a secondary headline that I was going to put out, and it was housing collapsing. And what we're seeing, I talked about this last night, just to go through some of the economic reports that came out today, is we did see mortgage apps down another 7%. The housing starts were missed as well, 1.358. Permits were down 1.473. And this is where the realization of what's happening in the permits was that the multifamily was one of the worst hit areas. And that's sort of interesting because if you think about what's really affecting inflation, it is that multifamily or the rentals are the big element in the inflation report. So all of a sudden, we're seeing a contraction a bit in building, and I know that there's absolutely no money in multifamily at the moment from a developer viewpoint, and it's not likely to get any better any sooner. And you know, the big story was commercial CRE, commercial real estate. That's really, and I've been telling you, that's really not that big of a deal because that's held basically off balance sheets. It's really not going to affect the banks as much. But just to kind of, it's a good segue for me is as we look at what went on with the banks today, the opposite of yesterday, everything got hit. The community banks down 2.8, regional banks 2.43, the big banks down 2.4. Morgan Stanley got absolutely hammered, down 6.8, primarily due to their money management area, which I suspect folks are going, hey, why should I risk any money right now? Just put money in T-bills. And so that may be a pretty tough business to be in at the moment as far as attracting new clients and getting new business. I suspect that's one of the effects that could come out of these higher yields. So there's so much, folks. I'm just going to show you. This is my sheet tonight. There's a lot to talk about. I'm going to go through all of these details here. Then after I finish this, I'm just going to cover the equity indexes and interest rates, and we're going to be done tonight. I'm going to start trying to shorten this up. It just so happens there's so much going on in the world right now. There's a lot to talk about. But so the housing permits were off. We also have that, like I said, the mortgage app's off. Everything's kind of imploding here, and this has been kind of a theme. It actually goes back about a month ago, because we're even seeing single-family rents are absolutely plummeting right now. So all of those BlackRock and all those fellows out there playing the corporate game, those things are all imploding. That relative income on that stuff is really starting to get a lot tighter, and it doesn't look like much is going on at all. And I would just tell them they should be glad they're not in Italy, because you can't sell anything in Italy right now. Italy's like the best deal on the planet if you plan on holding it forever. Let's take a look let's go to Thursday. Let's get all the economic stuff out of the way. Thursday, we have claims coming out expected 211. That number's been really tight, 209 last week. The continuing claims is 1.702 million. And I expect maybe this goes up a little bit, but we've just seen a complete resilience in the employment area from that standpoint. We also get existing home sales tomorrow. It's expected to come in at 3.9. The previous report was 4.04. So look for more softness there in existing home sales as well. So let's go back to the interest rates and bonds here for a minute. I think it's really important because we talk about the bond vigilante. There's only one primary bond vigilante. Well, there's two actually. The Fed doing QT, and you got Janet Yellen in the Treasury selling massive amount of bonds. They brought out the 20-year maturity again. I don't know whose idea that was. Maybe that will tell you that maybe the actual people who are issuing this debt are pretty sure that it is going to be higher for longer. I hate to use that term, but not only higher for longer, for a lot longer if you're willing to offer 20-year bonds. Think about that for a few minutes. And that should tell you a lot about what the mentality is of the Treasury right now. I mean, they're looking to lock down, high fours right now. So almost 5%. We did see the Treasuries tick up pretty good. I think 492. I'm going off memory. I didn't write anything down there. But this is an area that I've talked about a lot. I always talk about we're one bad auction away from disaster. Well, I won't show you tonight, but when we come into the first of the month, and I've told you about this before, when we cover interest rates, if you go back to the first, I think it was the first Monday or Tuesday of this month is when I did the long-term analysis. And I was telling you that on the 10-year, there's projections on a longer-term charts for 6.5, 6.7 on the 10-year. And we're printing, 4.9. So there's something going on here, and I'm going to try to unpack this without getting into too long of a rant tonight. But there's a number of things that are going on. So when I was talking about the markets declining, when Biden was talking, he was making it clear that we were going to support, the U.S., air quotes, is going to support the efforts no matter what happens in Israel. Now, the hope is that nothing happens, right? You park a couple big aircraft carriers and put a whole fleet over there, and you hope that deters everything. That's the hope, right? If that's not the case, and there is hundreds of billions, he was talking about $100 billion he's asking Congress for, and they're going to give it to him, and I'm not saying they shouldn't, okay? But this is what the kind of getting to the title of tonight is, are these wars going to actually end up just breaking the bank? And pun intended here is that the Treasury of Janet Yellen's, I got a quote here. She's like, hey, there's no problem. We got plenty of money. We can just do this forever. Joe Biden says forever. Everything's forever. And, I'm not sure what forever means, but they seem to think they have a handle on this. And I think it gets a little scary. Be one thing if we were $20 trillion in debt, But when you're 34 plus, it's a little different game, right? So it's like I've talked about this before on my VPNpartners.com website. There's an old presentation I put together. It was actually an annual report. I believe it was 2017, might have been 18. And I was talking about, basically that this debt, what is enough debt? It was at 18 trillion then, right? I was saying, was it 22, 24, 25? What's the number? Well, obviously, it's something greater than where we are right now. It's greater than 34, 32, 34. What's the number? And so at some stage, this becomes completely ridiculous. And maybe this is part of the plot, if you will, as we look at talking about the BRICS, the de-dollarization. There's a whole lot of stuff. I could go on for probably a couple hours, and maybe some of you would enjoy for me to do that. Maybe that's an appropriate thing to do at some stage. But at the moment, we're just seeing all of this stuff starting to stack on. In my opinion, of what I was seeing today, intraday, when the massive waves of selling kept coming in, was just those realizations. You're offering new securities. You got the President of the United States telling you you're going to spend hundreds of billions of dollars more of money you don't have, right? So when it says, well, this bankrupt the U.S., the U.S. is already bankrupt, okay? The only reason why they don't have to realize it is they're still able to continue to raise money, and people buy the bonds, and they keep buying and buying and buying. And, so at some stage, like I said, we got two bond vigilantes right now. You got the Fed doing QT, and I think they're close to done. That's the subject maybe as we come into the Fed meeting, done for the QT thing. I think that's a bigger issue than whether they pause on yields. It's when they pause on selling bonds. And I think they're getting pretty close to where the balance sheet needs to be. And they're starting to realize the competition and the pressure that they're putting on the market as well. So this next Fed meeting probably will be one of the most significant ones as we come forward. So much here, folks. I'm just trying to not walk down too many rabbit trails as I go through this stuff. I actually have even more notes here. So looking back just a little bit, as I mentioned yesterday, we saw all of the banks under pressure. We also saw industrials. They were starting to look like, hey, we just got to report industrial production. Looked pretty good. Looked like I was talking just 2 days ago about manufacturing, maybe industrial turning around. Now, maybe it was a blip, but it was down 2.4%. And this was all happening while the yield curve was actually steepening today. So I think what I'm going to have to do, I was going to have to cut this here. Hopefully I got enough context that you folks understand where I'm coming from on this. But basically, there is a lot of pressure out there. There's a lot of concern. And I almost put out a tweet earlier this morning. I was pretty busy in the markets early this morning, but I was going to talk about something I'm going to show you in a minute. The technicals, just from this lower opening and what they did, all the algos started to switch around. I'm going to show you here in a minute. All of a sudden, things got much more negative. Yesterday, I was talking about how the NASDAQ looked like a leader on the downside, and maybe some stability here in the futures on the E-minis and on the S&P. But everything is changed overnight and changed by today's action. Last I looked, we had a little slight bid. So let's go ahead. We'll cover the database, which I think that's going to get interesting as well. And then we'll go right through the technicals. So this will be probably the longest part of the video tonight, but I'm going to slam through. So this is the plan again. We're doing the database. We're doing S&P, NASDAQ, Russell, and interest rates, and we're done tonight. So I'm going to come up with a format. I really was hoping to get this done really quick tonight, like 15 minutes click, and we're already 17 in. So that's not happening. And it was all because of all of these notes I have here. So anyway, so let's go ahead and get into that. All right, so the database did tick up a bit yesterday. We're looking at 2,510 buys versus 315 sells. That was for this morning's opening. So probably with the lower opening, at least got some decent pricing on some of those buys, but I wouldn't be surprised at all to see a negative rotation after today. And we're still on well under 42%. So the noise in here is really, how's the best way to, the noise is going to increase here. I have notes here. Is there, and I'll probably do this. I'll do this tonight because I'll cover it real quick because I think it's of interest. I have the TA35, which is the Tel Aviv index top 35. And I want to cover the shekel a little bit because I think looking at what's going on in Israel, I have always used technicals to be able to guide me and give me some expectations on what the markets might do. So we'll take a quick glance at that right after the S&P before I go into the NASDAQ. So, but the overall database, I do expect it to kind of flip around after this negative action that we saw today. There was one thing, and I'll show you in a minute, but we had a massive short covering rally right at the end. I mean, we printed down to 32 in the S&P, and it bounced all the way back into a 50 handle. So it was pretty impressive. Let's go ahead and take a look at the technicals here on the S&P. All right, so we have the hourly chart up here. And it's interesting because it is suggesting that we have a potential recovery coming in, of course, into the London Open. It looks like it's not going to be this big rally. We're probably going to head back towards the 10-period moving average. The 21 is going to be your primary resistance. If you're looking at the hourly graph, that's going to be a point where you can see if we do rally into the London opening, that probably where you get a rejection. And it looks like it's kind of stabilizing from there. We'll see what happens from that viewpoint. Let's go ahead and take a look at the daily and get into the market grid here. This is interesting, and I'm not sure how I missed this yesterday, but we do have some new downward projections here, which are sort of scary. And this is what I was telling you. We were looking at overall that the algos were suggesting that we start to climb up a little bit here in the pattern. All of a sudden, if you look at PPM1 is actually turned drastically negative. We're holding right on the first derivative. Looks like we're going to hold that through tonight. But if we break through there, and we're probably going to see some decline. And here's the new downward fib target. So the bears out there are going to love this. 4,100, 39.73, and 38.95. That's these objectives here. Now we've got two of them. We'll see if this ends up to be one of the, what I call an island projection here. But we do have some pretty decent downside action. Looks like it's coming in, and we're going to start to test some of these key values under the markets. I talked about yesterday just of coming back into that 43.60, 43.40 level. And man, we just blew through that. We printed 32, I believe was the low yesterday. Let me double check that. Actually 30.75 was the low. And we rallied from 30.75. If I brought up the 5-minute graph, you would see we rallied from 30.75 back to a 50 handle. So 20 handles. And that all happened in pretty much the last maybe 18 minutes or so. Might have been a touch longer, but right in that range. So what we're seeing here is further attrition. The only thing that is giving me pause for getting super negative here is that the 21 Augos and the 40 are suggesting that we have stability in here. And those values, 43.48, we're trading 43.46. It's almost that rally back that I was just talking about was enough to satisfy to get back into those moving average values right there. 43.74 is the 10, and the 10 is still positive, folks. It's up 0.12. ppm 2 is negative by just a little bit at 0.10, and ppm 3 is flat as well. So those values are 43.48 and then 44. Let's see here. Let me get the right value. Yeah, the flat number is 44.15. So that's where we were topping out. I was talking about those values that we kept pegging from that standpoint. Let me make this chart a little easier for you to see the values. So we got up to, this was 44.23 just on Tuesday, and we printed up in here, and it was right on that 40 period moving average, and it got rejected off of there. So we saw a rejection all the way down to the STX level. Yesterday we went just below it. STX was 43.40. Like I said, we printed 30. We closed back above it, so we did not get an STX buy signal here. But we're looking kind of interesting here. There's still some fib targets that are embedded in here. 43.67, 44.17, 44.48. We haven't negated those just yet, so they're still lying in the middle of this pattern here. But this ppm1 is concerning here, that it looks like we're going to lose some momentum as we come in to the end of the week. The opposite is happening here on the 21 is starting to roll out, but that doesn't mean, if we look at the market grid for tomorrow, S1 is 43.27, which is a slightly new low for what we printed on Wednesday. R1 is 43.56 and R2 is 43.73. That puts us back into those averages I was just talking about. That is the 10 period moving average is